There are cars sitting on forecourts all over Britain right now that have never had a second owner, brand new. Some still have the factory plastic on the seats. And they're not there because nobody wanted them, they're there because somebody did want them, bought them, drove them home, and then handed them back. It's happening in numbers that would have seemed unthinkable 5 years ago. Dealerships from Inverness to Plymouth are processing returns. Finance companies are logging voluntary terminations at a rate that's quietly alarming the industry. Consumer rights solicitors are busier than they've ever been. And yet if you walk into most showrooms today, you wouldn't know anything unusual was going on. Everyone's still smiling. The coffee machine is still on. The deal of the month is still on the whiteboard. So what is actually happening? Why are millions of UK drivers walking away from cars they were so excited to buy? And more importantly, is it going to get worse before it gets better? Let's start at the beginning. Buying a new car in Britain has never been straightforward, but somewhere in the last decade, it got genuinely complicated. When you walk into a dealership, you're rarely asked, would you like to buy this car? You're asked, what would you like your monthly payment to be? That distinction matters more than most people realize, because it means the conversation has already shifted from the product to the finance. And once you're in that world, you are playing on someone else's turf. Personal contract purchase, PCP, has become the dominant way that British drivers buy new cars. The pitch is seductive. You pay a deposit, you pay manageable monthly installments for 2 or 3 years, and at the end, you either hand the car back or pay a final balloon payment to own it outright. Most people hand the car back and start the cycle again. The result is that you never actually own the car, you're renting it with an option to buy. For years, that model worked well enough that nobody asked too many questions. Then came a ruling that nobody in the industry wanted to arrive. In 2024, the Supreme Court delivered a decision that sent shockwaves through every car finance company in the country. The case centered on something called discretionary commission arrangements, a practice where car dealers were quietly paid extra commission for setting the interest rate on your finance deal higher than it needed to be. The higher the rate they could convince you to accept, the more money went into their pocket. And here's what makes it particularly striking. Most buyers had absolutely no idea this was happening. The conversation in the showroom felt like they were getting help. They were actually being steered. The Financial Conduct Authority, the body that regulates financial products in the UK, had already banned the practice in 2021. But the Supreme Court ruling went further, confirming that millions of past agreements were infected by a conflict of interest that borrowers were never told about. And it opened the door to one of the largest consumer compensation cases British financial history has ever seen. The numbers are staggering. 12.1 million agreements are believed to be eligible for review. The total compensation bill is expected to land somewhere around £7.5 billion. That is not a typo. The industry as a whole is bracing for a cost north of £9.1 billion when you include related expenses. Average payouts per driver could reach £829. Some are expected to receive significantly more. Lenders, including some of the biggest names in UK car finance, have been quietly setting aside hundreds of millions to cover the claims. Ford's UK finance arm alone disclosed a provision of £61 million in a single filing. The High Tribunal ordered a partial suspension of the formal redress scheme until December 2026 at the earliest, meaning most payments won't physically arrive until 2027. But the awareness is there now. Millions of drivers know they were overcharged. And that knowledge has changed how they feel about the cars they're still paying for. When you discover that the deal you signed was built on a foundation that wasn't quite straight, that the dealer who was supposedly helping you find the best rate was actually incentivized to find the worst one for you, it changes how you feel about that car sitting on your driveway. It changes how you feel about the payment leaving your bank account each month. And for some drivers, it changes what they decide to do next. That's one thread, but it's not the only one pulling things apart. Let's talk about electric cars, because nothing has created more buyer regret in the UK in recent years than the rush to go electric at exactly the wrong moment. The pressure to switch to EVs has been building for the better part of a decade. Government messaging, manufacturer advertising, and a general sense that petrol was becoming socially unacceptable all pointed the same direction. Get an electric car? The infrastructure is coming, the technology is ready, you won't regret it. Hundreds of thousands of British drivers took that at face value and made the leap. And some of them are still happy they did, but a significant number are not, and their reasons are specific enough to be worth examining carefully. The charging situation is genuinely better than it was. As of 2026, there are over 88,000 public charging points across more than 45,000 locations in the UK. On a well-planned motorway run, in a modern EV with a decent battery, the experience is tolerable. The thing is, Tolerable is not what people were promised, and it is not what dealers implied when they were working to close a sale on a Saturday afternoon. The problem that persists isn't what you'd call range anxiety, it's reliability anxiety. Drivers who've navigated to a rapid charger on a retail park, only to find 3 out of 4 units displaying error codes, know exactly what that phrase means. You know the charger exists. You don't know whether it will actually work when you arrive. That distinction, on a cold January morning somewhere on the M6, is a very different experience from the brochure photographs of happy families plugged in outside a countryside cafe in golden hour light. Then came an unexpected cost shock that blindsided a lot of EV owners. When electric cars were introduced to the UK market, they were exempt from vehicle excise duty. That exemption was a meaningful financial argument for choosing an EV over an equivalent petrol car, especially when the purchase price was higher. From April 2026, that exemption is gone. Electric cars now pay the standard rate of £200 per year. And if your EV had a list price above £40,000 when new, which covers the majority of electric cars sold in the UK, you're also subject to the expensive car supplement, £440 per year, applied every year for 5 years from the second year of registration. That's £640 a year in road tax alone, on a car you were told would be cheap to run. Some drivers who sat down and recalculated after the announcement felt physically winded by the numbers. Add to that the reliability problems. Early electric models from several manufacturers arrived with software faults that made the first years of ownership feel like a beta test. Touchscreen glitches, charging system errors, advanced driver assistance systems requiring constant recalibration. In the first 6 weeks of 2026 alone, over 100 vehicle recalls were issued in the UK, a striking figure, driven largely by the explosion in electronic complexity in modern cars. A recall doesn't mean the car is about to fall apart, but it does mean returning to the dealer, waiting for software updates, sometimes driving a courtesy car for days while something gets resolved. Nobody budgets for that time. Nobody factors it into the monthly cost comparison. The result is that some EV buyers are exercising voluntary termination to hand their cars back. Some are invoking the Consumer Rights Act. Many more are simply riding out their contracts in quiet frustration, already certain they won't be choosing an electric car again, at least not this version of the electric car. Now, voluntary termination, it's worth explaining this properly, because a lot of UK drivers genuinely don't know this right exists, and some of those who've heard of it don't understand how it works or when it applies. Under Section 99 of the Consumer Credit Act, 1974, if you're in a regulated hire purchase or PCP agreement, you have the legal right to return the vehicle and walk away from the remaining payments, as long as you've already paid at least half the total amount payable under the agreement. That total includes everything: your monthly payments, the interest, any fees, and the optional final balloon payment in a PCP deal. Because that balloon can be a very large number, many PCP customers don't hit the 50% threshold until well into the back half of their contract. But when they do, the right to terminate is real. It is legally protected under British law, and the lender cannot simply refuse it. There's a catch. The vehicle has to be returned in condition consistent with fair wear and tear. Anything beyond that, and you'll face charges. Excess mileage already accrued may also carry a cost, and the agreement will be recorded on your credit file as terminated early, not the same as a missed payment or a default, but something future lenders will see and take into account. For many drivers, that's an acceptable trade-off. For others, it isn't. But the key point is that the choice exists, and exercising it is a legitimate legal act, not some kind of financial failure. Tens of thousands of drivers are using this right now, some because the finance deal wasn't what they understood it to be, some because the car developed faults the dealer couldn't resolve to their satisfaction, and many more because life changed in ways they hadn't anticipated when they signed the contract. A job loss, a change in circumstances, a household budget that can no longer absorb a payment that felt manageable 18 months ago and simply doesn't anymore. Because this is the other thing. The raw cost of owning any car in Britain in 2026 has become brutal. Car insurance premiums have risen by 58% since 2022. Not gradually and imperceptibly, 58% in cumulative increases that have stacked relentlessly year after year. The average comprehensive premium nationally now sits at around £560, but that national average disguises a much harsher reality for younger drivers, drivers in urban areas, and anyone who owns a newer or more expensive vehicle. Some households are spending close to or well above £1,000 a year just to insure their car. The reason is straightforward and structural. Repair costs have surged. The average accidental damage claim in Q1 of 2026 was £3,699, up 8% in a single quarter. Modern cars are harder and more expensive to repair. The cameras, sensors, radar systems, and structural crumple zone designs that make them safer in a crash also make them dramatically more costly to put right afterwards. The repair bill goes up, the premium follows, and the driver absorbs the difference. Then there's fuel. Petrol and diesel haven't returned to the prices drivers remember from before the cost of living crisis. The pump is still painful on a weekly basis for anyone doing real mileage. And car prices themselves have climbed sharply. Analysis of the market suggests that a car costing £20,000 in 2020 now costs somewhere between £25,000 and £28,000. Wages have risen in that same period, but when you adjust for inflation, the real terms gain in purchasing power over those 5 years is approximately 0.6%, 0.5%, against price increases of 25 to 40% on the vehicles themselves. That gap doesn't close, it compounds. It's also worth saying something about the private buyer specifically, because the aggregate market figures hide what's happening to individual families. Fleet sales and business purchases continue to hold up reasonably well. Companies buying vehicles in bulk have teams of people to manage the contracts, negotiate terms, and monitor costs. The private buyer has none of that. The private buyer is one person, usually buying one car, usually under some emotional pressure, often during a life event, a growing family, a new job, a car that finally gave up. Private buyers made up just 38.6% of new car registrations in 2025. That share has been sliding for years, and it's sliding for a reason. The economics of buying a new car privately in Britain have shifted enough that a growing number of people are simply opting out, going used, going older, or going without altogether. The ones who don't opt out and do sign on the dotted line are the ones most likely to find themselves regretting it. There's one more factor that doesn't get talked about enough: the ZEV mandate. The zero-emission vehicle target requires that 33% of all new cars sold in the UK in 2026 be fully electric. For every non-compliant vehicle sold outside a manufacturer's allowed quota, the fine is £15,000. That's a serious number, and it creates a commercial incentive inside the showroom that is invisible to the buyer but very visible to the salesperson. Nobody is ordering anyone to buy an EV. But when the deal on an electric car looks exceptional, when the finance terms are better, when the stock is more immediately available, when the salesperson's enthusiasm for that particular model is noticeably higher, it's worth understanding that there are business reasons behind that enthusiasm that have nothing to do with your interests. Some buyers who made the switch to electric under that kind of soft pressure are now among those regretting the decision. Not because EVs are universally wrong for everyone, but because they were wrong for those particular people at that particular moment in their lives, and the conversation in the showroom wasn't designed to surface that honestly. Here's what nobody in the car industry wants to say out loud. A new car has become a financial trap for a meaningful proportion of the British public. Not because the cars themselves are bad, many of them are technically remarkable, more capable, and more safe than anything that existed a generation ago. But because the system surrounding them, the finance structures, the layered costs, the regulatory pressures, the fine print has become so complex and expensive that what looks like a manageable decision on the day of signing can become a very different proposition 24 months later. Consumer rights experts have noted consistently that most drivers don't know what they're entitled to until it's too late. They don't know they can reject a car within the first 30 days if it develops a significant fault that was present when they bought it. They don't know they can demand a repair or replacement for up to 6 months. They don't know about voluntary termination. And by the time they're struggling with a car they can't afford, or one that hasn't worked properly from the start, they assume they're stuck, that the contract is the contract and there's nothing to be done. They're often not stuck. But the information is buried in documents most people don't read fully at the time of signing, and the industry has no particular incentive to make it easy to find. The people in the comments sections of videos like this one, the drivers who write in to say they handed a car back, or rejected a faulty one, or finally challenged a finance company and won, are not unusual cases. They're representative of a much larger group who went through the same experience and simply stayed quiet about it. What's changed is that more drivers are talking, more solicitors are marketing their services to this exact market, and the overall awareness that these rights exist is higher than it has ever been. So where does this leave things? The UK car market isn't collapsing. Roughly 2 million new registrations are still expected to land in 2026. Fleet buyers and corporate purchasing continue to prop up the overall figures. The manufacturers aren't going anywhere, but something has shifted in the relationship between British drivers and their cars. The aspirational glow that once surrounded a new car on the driveway, that sense of arrival, of reward earned, has been dimmed. Not extinguished, but dimmed. And the drivers handing their cars back aren't giving up on cars. They're giving up on a version of the market that stopped working for them. The next few years will reveal whether the industry responds to that signal or ignores it, whether manufacturers, dealers, and finance companies look at the returns and the terminations and the compensation claims and decide to rebuild some trust with clearer pricing, more honest conversations about total ownership cost, finance products that are genuinely transparent about what the buyer is agreeing to, or whether the machine keeps running as it always has until the next regulatory intervention forces the change. For drivers, the practical advice is unglamorous but real. Before you sign anything, calculate the total cost of ownership. Monthly payment, insurance, fuel or charging, VD, servicing, tires, and what happens if you need to exit early. Ask the dealer directly what commission they earn on the finance product they're recommending. Know your 30-day rejection right. Know what voluntary termination requires. And if anything about the deal feels like it isn't quite adding up, trust that instinct, because the instinct is very often right. A new car should be a good thing. It should feel like a decision you made clearly, with full information, in your own interest. Millions of people across Britain right now feel it was something else, and the industry has a long way to go before that changes. If you've been through this, handed a car back, rejected a faulty one, found out your finance deal wasn't what it appeared, leave it in the comments. This stuff matters. And if this video was useful to you, you know what to do.